Good morning. Could somebody just let me know in the chat if you can hear me? I want to make sure my audio is working before we get started. Okay, looks like we're good to go. I'm going to wait maybe 30 seconds, let a few more people join, and we'll get started. All right. Well, good morning, everybody. My name is Clark Engel. I'm with Everhart Advisors. Thanks for joining our monthly Everhart Advisors University. Topic today is college planning. So I'm going to cover a lot of material. My goal is that you would feel a little more confident walking out of this session than you do right now when it comes to just preparing and paying for your children's college expenses, or maybe even your own if you're planning to go back to school. I'm in this with you. I've got a 1-year-old daughter at home, and uh, putting a little bit of money away every month for her future college expenses. So we'll go ahead and jump right in. So, question to kick us off. What's the estimated cost 18 years from now for a 4-year private university? So this would be all in tuition fees, room and board. Uh, take a guess here. Lock in your answer. What do you think that total cost would be over 4 years, 18 years from now? So imagine you've got a newborn that you're saving for. It's D. It's the highest one on there. Over $500,000 uh, to attend a private institution. That's a whole lot of money. Now, you know, some people will go that route. You know, a lot of people will not. Maybe you'll go to a public university, or and also you're probably not going to be paying that full cost when you have some maybe grants or scholarships, things like that. But if you look at the cost now, to attend a public university for 4 years, it's a little over $100,000. Private is around 226, but that 18 years from now number for public is 261,000, and private is 545, like we looked at. That's assuming that the cost of education is going up by 5% every year. So what we've seen for the last couple decades is that cost of education is increasing really by about double the rate of inflation, which seems kind of crazy because inflation has been really high lately. It typically runs around 3%, but education has been increasing by more than that. So just want to make you aware that, like anything in life, there's some planning involved in this. Don't want to scare you at all, but just, give you the information that, if you're expecting your child to attend a 4-year university or college, you're looking at a pretty large expense here. So how do people pay for this? A lot of ways that families pay for this. You can see kind of the big one there that takes up almost a quarter of the chart here is just current income from the parents, so kind of paying as you go. Scholarships and grants are closely behind that. We'll talk about those. Um, Really, the main categories of funding college is grants, loans, scholarships, and savings. All right. You can see, federal and private loans toward the middle of the list is a decent chunk. We'll talk about those as well. But a lot of different ways that people are funding college. Want to make you aware of what these different options are, how they may affect you, so that you can put together a plan for yourself to figure out, are we going to be funding this as the parents? Is our child going to be funding it? A mix of the two? Is it going to be through, investment account that we've saved into? First big thing I want to get into here is the free application for federal student aid. So this is the FAFSA form. You've probably heard of that before if you certainly if you have kids in college, or maybe you've are at least familiar with it if you have younger kids. But this is a free form, as stated in its name. Every family should complete this. The reason for that is most people qualify for some sort of financial aid, even if you feel like you're really well off, your income's high, you've got a lot of assets, still fill this out. Um, Grants, many scholarships, and the big one is loans, all run through the FAFSA. So if you're taking out federal loans, you need to fill out that FAFSA form. The earliest you can do this is October 1st of the child's senior year in high school. And nice thing is they don't necessarily have to know where they're going to go to school yet. You can put up to 10 schools on that form. Now, I wouldn't delay this. The window to fill out the FAFSA is October to June, but I would get this filled out as soon as you can, really October, November timeframe. Schools only have so much grant money that they can give out. So once that's gone, it may just be loans that are offered where, you're paying back on those loans, whereas a grant is an aid gift that you don't need to make a repayment on. And also, don't forget to just renew this FAFSA annually. So initially, it's going to take about an hour for most people to complete this. Just to prep, make sure you've got, a list of your assets, your investments, your properties, things like that, just information that you're going to need to fill out the form. Renew this each academic year, or you're not going to qualify for additional aid as you move forward. All right. So on this form, you've got reportable and non-reportable assets. I thought this would be helpful to share just to give you an idea of what's being looked at by the government on these forms. So, I'll let you read through these, but kind of the big ones for reportable assets would be any real estate that you own outside of your primary residence. So your home that you live in is not a reportable asset. Really, any bank product that you own, like cash, money market, CDs, investment accounts would be reportable as well, but not retirement accounts. You see that on the right-hand side. So, investments, if you own like individual stocks or bonds, or you've got a brokerage account with some funds in it, that would be reportable. But your 401k, your IRA, pensions, retirement plans do count count, which is nice. 529 account, which we'll cover pretty in depth, is reportable if it's owned by the parent, but not if it's owned by the grandparent. So those are really the major ones for reportable versus non-reportable assets. And we'll kind of get into those 4 main ways that people fund college. First one being grants. So these are needs-based, and they do not have to be repaid. So this is an aid gift from the university. The way to figure out what your financial need is, you take the cost of attendance for the institution that you're attending, you subtract out something called the student aid index, and then that number is going to be your financial need. Okay, so the student aid index was formerly called the expected family contribution until last year. They changed it to SAI. That student aid index is gathered from the information that you put on the FAFSA. Okay, so looking at your family income, assets, but they're also looking at how many kids you have. So if a family with multiple kids, they're probably going to have a harder time, coming up with the funds to put toward every kid's college. So their student aid index would be a little bit lower. The lower the SAI, the higher your financial need number is going to be. Okay, the SAI is basically, how much would a family like yours be expected to be able to contribute toward college? Okay. Your family's income has a much bigger impact on this number than the assets, but the assets still matter, of course. And like I mentioned before, grants are, a lot of them are first come, first serve. So make sure you're getting that FAFSA done in a timely manner. Scholarships. So most people think of scholarships as, athletic or academic scholarships. You hear about people going on a full ride scholarship. They got a perfect ACT score and they were in, National Honor Society. They were in all these clubs in high school. They got into a big time college and got a full ride. That's very, very rare. 1.5% of students receive a full scholarship. The other 98.5% do not. Okay, so it's possible, but um, unlikely that your child's going to have a full ride scholarship. But this is a pretty interesting topic. I would do a little research or have your child do a little research. Maybe when they're in high school, starting to think about where they want to go. There's 1.7 million private scholarships out there for a plethora of different things. So hobbies that you have, maybe do some research to see if there's a scholarship opportunity there. There's ones for minorities, different ethnicities. um Typically scholarships are merit based when it comes to receiving it, an academic scholarship for your school. But this is where I would take a little time, maybe have your child um, do it, or you can help them with it, but do a little research, see what's out there, because you don't want to miss out on some extra money coming your way. So scholarships, similar to grants, do not have to be repaid. This is a gift from the institution you're attending. Loans is a big one here. Wanted to kind of break this out to give you a clear picture of the different types of loans you can take out for college. So the 30,000 foot view is federal versus private loans. So federal loans are offered by the federal government. Private loans are offered through banks or other financial institutions. There's three main types of federal loans, and then really we'll get one category of private here. So federal, you've got subsidized, unsubsidized, parent plus. We'll go through the differences here. IR is interest rate. So for this school year, you've got a 6.39% interest rate. For subsidized and unsubsidized loans, you've got an 8.94% rate for Parent Plus. And then private loans typically just have a higher interest rate, not all the time, but typically we'll see a higher interest rate on those private loans. Needs-based. So a subsidized federal loan is the only one on here that we would call needs-based. So if we go back to that calculation we looked at, you have to have a financial need in order to take out a subsidized loan. You do not have to have a financial need to take out the other three. So a subsidized loan is nice because interest does not accrue until 6 months after you graduate. So if you're taking out that loan in your first year of college, that's 4 years of interest accumulating on that loan, where your balance that you owe is going to be higher when you start making payments than the original amount you took out the loan for. So with all the other three options, that interest is going to start accruing immediately, but the subsidized, it is not. Subsidized, you can only take out a loan for as much as what your financial need is. It cannot exceed that. And then for the other two federal options there, the amount you take out just cannot exceed the actual cost of attendance for that year. And then private's really set by the lender. You're looking at your credit score to see what you qualify for. So, you know, you want to go for those subsidized loans first because that interest is not accruing until after you graduate. Um, and subsidized, you've got that limit there to your financial need. But then you would look at an unsubsidized loan, and then I would look at private loans to really fill the gap in any funding there. So you're looking at grants, scholarships, subsidized, unsubsidized federal loans, and then kind of last resort would be private. Um, Parent Plus loans are taken out by the parent of that child, and you cannot transfer that loan to your child. It's your responsibility to pay it off. Okay, the other three are loans taken out by the child. All right, so talked about the different ways people save for college. What are the steps to actually accomplishing this? So we're going to identify your savings profile, choose a vehicle, determine an amount, and then get started, which is sometimes the hardest part. All right, so savings profile. Before you determine how much you are going to save, figure out what kind of saver you actually are. So family values, financial goals, what means do you have? I mean, you've got to be realistic here. There's many goals that we're all saving for, saving for retirement, saving to buy a house, saving for college. There's a lot of things there. And college is, ranked differently on the priority list for each family. So think through that. There's really three main profiles that I've built out here. It's not a catch-all, but I think this captures where many people would be at. Profile A is, responsibility is on my child to pay for their schooling. They can choose to go where they want, but it's on them to cover the cost. All right. So this is going to build character for them, be a meaningful accomplishment. They're definitely going to grow up financially, um, figuring out how to cover those costs. This is a very realistic solution. I see people go this route, that does not mean that you're doing anything wrong. Hopefully you're saving well for your own retirement and you've got, other parts of your financial life in check. But, typically children who graduate and they have had to cover the costs themselves, they may come out very financially responsible. Um, Profile B is probably where most people fall into, I would say. So I want to fund my child's college as best that I can. I think it's a worthwhile goal for them. I probably don't have the ability to fully fund everything, but I'm going to put as much as I can toward this. We're going to pursue scholarships and probably look at loans. If you've got more than one child, this is, again, a very realistic solution. And then C is going to be, I'm going to fund it all. This is a priority for our family. I want to provide this for my child. I want them to experience everything that college has to offer, maybe even leave a legacy for my grandchildren. Um, I will say, so I've come across a few people now, in the last couple of years, a couple clients, a couple people inside of our 401k plans where they've saved really well for their kids' college, saved into 529 accounts, um, maybe 100 or 200,000 plus saved into 529s for their, oftentimes two or three kids, but they've got like less than $100,000 saved for their own retirement. And you're in your 40s or 50s, and your kids are going to be in great shape coming out of college, but now you're 10 years away from when you would want to retire, and you're way behind the eight ball. You know, it's not cheap to live these days, and your costs are going to keep going up in retirement. So, the focus of today is not retirement, it's college, but I would encourage you to have an intentional conversation with your spouse and with your kids when they're old enough so that everyone is on the same page as to how this is going to be funded. I wouldn't suggest that you blindly tell your children that you are covering 100% of their college, and then, they decide to go to a private school that's going to cost 200 grand plus, or you've got two kids and they're at private schools, or one goes to public. Maybe smart to say, we're going to fully fund this up to a certain cost or at certain universities. Don't want to tell you how to have that conversation with your child, but just make sure you're communicating so that everyone's on the same page. All right, now we're going to choose a savings vehicle. A lot of different options here. There's multiple different accounts that you can use to save for college. I'm going to compare three of them, and then we're going to look more closely at 529 college savings plans as what we think is the best option. So 529 is specifically for higher education costs, and UTMA is a custodial brokerage account. So this account, the money in this account has to be used for your child. Your child is the owner of an UTMA account, and you as the parent are the custodian until they reach the age of majority in your state. An earmarked TOD, that stands for transfer on death. That would be, a brokerage account for you as the parent that you have just set aside and said, this money is going to be used for our child. Whether it's college or, helping them pay for a first house or get started after school. The parent is the owner of that TOD. Okay. Taxation on these accounts. So 529, the great benefit here is the investment is growing tax-free, whereas earnings or growth on your investments on the other two options here do get taxed. Investment options, 529, you are limited to the options inside your plan, but typically you've got several different funds that you can choose from, kind of similar to how your 401k fund lineup would work. There's age-based investment options. I use the Ohio 529 college savings plan for my daughter, and there's plenty of options in there to choose from, but you are limited to those options. Whereas with the UTMA and the TOD, it's unlimited. You can open those accounts wherever you want, do it on your own, work with an advisor. You're going to have more options. And then, with a 529, the parent is the owner of that account. Same thing with the TOD, parent's the owner. The UTMA, is the one there where the child is really the owner of the account. Okay. So let's dig into 529 plans. Why do we like these so much? Talk about, some of the benefits here, and then a lot of myths about these accounts. So, information that's not necessarily true that gets circulated out there. Want to cover those and kind of give you the facts. So tax advantages is the big thing here for 529s. These accounts are growing tax-free, and the withdrawal is tax-free as long as it's used for higher education. If you are in the state of Ohio, you can receive up to a $4,000 tax deduction per beneficiary. So that's, 100 or a couple $100 of actual tax savings on your return. And then the annual gift exclusion applies when you're funding 529. So this doesn't come into play for a lot of people, but you can contribute up to $19,000 to a 529 for this calendar year. Or you can bunch this up front. So you could do 5 years of contributions in that first year, which would be $95,000. Or if you're married and funding it, you can do double that. It's $190,000. If you go above those gift amounts, you have to file another document with your tax return, and it ends up eating into your lifetime gift exclusion. I won't get into that specifically, but just be aware of those, gift limits there. And if you're going above it, probably talk with your CPA just to get some guidance. Like I said, the parent has control over these accounts even after your child reaches legal age. And they're flexible. Okay, so anybody can contribute to a 529. Doesn't just have to be the parents. And then the account owner can change the beneficiary. So if you've got, 3 kids and you've got 3 separate 529s set up for them, and your oldest kid graduates high school and starts working a job immediately, doesn't do any schooling after high school, you can change the beneficiary from that child to another one of your children. All right, so we'll go through some of these myths. 529 can only be used at schools that are in my state. That's actually not true. The assets in the 529 can be used at any institution that has federal accreditation. So can they accept federal student aid? So this would be, obviously your 4-year colleges and universities, but community college, 2-year programs, graduate, doctorate programs, trade schools, even some schools abroad would accept 529 assets. You also don't have to use the state's program that you live in. So I live in Ohio, I use the Ohio 529 plan, but you can use any state's 529 plan. And then if your child lives in Ohio and they go to school in California, you can still use those funds as long as it meets the federal accreditation. I make too little or too much money to qualify or contribute to a 529. There's actually no income limitations. This can be funded by any person at any income level. My child decides not to go to college, I lose the assets in the account. These actually have more flexibility than you think. All right. So like we already said, use of this money is not just limited to a traditional 4-year school. You can change the beneficiary to somebody within your family. So you could even change that beneficiary to yourself if you decide to go back to school. These assets can always be returned to you or just withdrawn. And if they're not used for higher education, it's just a non-qualified withdrawal. Okay, so what happens there is your contributions come out tax and penalty free, but the earnings on your investments you pay taxes on plus a 10% penalty. Okay, so ideally you're not paying that taxes and penalty, you're using it for college, but it's not the end of the world, I would say, if it is a non-qualified withdrawal. And these assets can grow in perpetuity. Generally there's no time or age limit on when you have to use this money. New rule that was added in 2024. This is so one of the concerns for people using a 529 has always been, maybe I've got 1 or 2 kids, I saved well for them, but they didn't do any schooling after high school. And what do I do with this money now? I can't change the beneficiary to another child. I'm just going to take out that non-qualified withdrawal. Well, now what you can do is transfer up to $35,000 from that 529 to a Roth IRA for your child. So it would be a Roth IRA in your child's name for them to grow for their own retirement. Couple things to watch out for here. The annual contribution limit still applies. So you can only put $7,000 a year into a Roth IRA. So you'd have to space this at least over 5 years to get to that $35,000 limit. The 529 has to have been open for at least 15 years with that current beneficiary's name on the account for at least 15 years. And then your child also has to have earned income. Okay, so if you're transferring $7,000 to a Roth IRA for them, they need to have earned income of at least 7,000 through working a job for that year. But this is a great, new solution for people out there that have extra money in these accounts when your kids have graduated, or maybe they just didn't do college. You've still got a great option here to kick them off with, money in a Roth IRA that they can grow for themselves. 529 plans can only be used for tuition. Tuition's included, but you can also pay for room and board, mandatory fees, books and supplies. When you get into mandatory fees and books and supplies, that can be pretty lenient with what's included in that. So, most of the costs that come along with college can be covered through that 529. Investing in a 529 lowers the chance of qualifying for financial aid. This asset actually has a relatively small effect on financial aid. So this plan is considered an asset of the owner. So typically what we see is the parent is the owner of the account and the child is the beneficiary. So the parent's assets would get factored into that student aid index that we looked at a rate of 5.6%, which is much lower than anything that's considered a student asset gets factored in at 20%. Now, one other thing to think about here is if a grandparent is the owner of a 529, then this account does not get factored at all on the FAFSA. So maybe, you could talk about having a grandparent open the 529 and be the account owner. Anybody could fund it. So you as the parent could still fund it. Maybe the grandparents want to put some money into it. Doesn't get factored in on the FAFSA. You can still have that child named as the beneficiary. If my child receives a scholarship, I lose the money in the account. Like I said, these assets can be returned to the owner at any time. If the beneficiary receives a scholarship, you can pull, up to the amount of that scholarship from the 529, and you would not have to pay that 10% penalty on the earnings. You would still have to pay income tax on those earnings, but the penalty gets waived if you're pulling out for what the scholarship was for. And then like we talked about, there's flexibility here, so you can change the beneficiary. And these accounts can grow for as long as you want. So, you keep the account invested for 10 plus years, and then you could change the beneficiary to one of your grandkids and use that money for them. Only a parent can be the owner. I already mentioned this, but grandparents, aunts, uncles, friends, literally anybody who's a US citizen can be an owner of the account. Even corporations and trusts can be owners of the accounts. I'm the only person that can contribute to the 529. Non-account owners can also contribute. Okay, so they're not able to direct the investment or have any control over the account, but they can contribute to the account. They would have those same gifting limits that apply to them. So each person that's contributing has that $19,000 limit for this year, or $95,000 to do the lump sum for the 5 years. And in some states, the contributor, so somebody who's not the owner but just contributing, you can still take that state tax deduction, and Ohio is included in that. You can take that state deduction, and for Florida, there's no state income tax, so no need to get a deduction there. All right, and then last kind of bullet here was determine an amount to save and then getting started. So, generally here, if you're looking at an in-state public school versus mid-level private versus elite private for your child, to fully fund this, if you're a profile C, you're going to fully fund this. you need to save 3, 6, or $9,000 per year per beneficiary. Okay. So just want to give you, general numbers there as to what you'd be looking at to get close to fully funding that. Like I said, most people are not a profile C, so don't feel like you have to do that if it's not within your means. There's a good online calculator when it comes to college savings or retirement savings at bankrate.com. You can scan this QR code. Use us as a resource. We do these monthly webinars, but you've got access to us whenever you want to set up a meeting and talk through some of these things. And there's one more example I wanted to point out here before we wrap up. So there's some danger here in delaying your savings. You've got a great opportunity if you have a newborn at home to start putting away a little bit every month over 18 years. But the more you delay that, the more difficult it gets to fund a large chunk toward college. So on the left-hand side here, this is if you're saving $350 per month and you start that when your child is born, then you would have about $135,000 at age 18. If you start at age 5, you get 82,000. You wait until age 10, but you're still doing that 350 a month. Now you're looking at about 43,000. And then on the right-hand side, what if you had a goal of saving up $150,000 by age 18? Well, if you started monthly contributions when they're a newborn, it's $387 a month to get to that number. If you wait until age 5 to start, it's $637. And if you wait until age 10, it's over $1,200. So, it's same things that you've heard us talk about when you're investing money for other goals as well. The amount of time that you can let that money grow for you is the biggest factor to the ending balance. So give yourself enough time. If you've delayed it up to this point, thank you for jumping on the call and wanting to learn about this. That's a great step. Don't feel like it's too late to get started. Start putting away something now, and that can make a difference when they get to age 18. All right, so for Ohio and Florida, I know probably got a lot of people on the call from these two states. Just wanted to provide QR codes here to the landing page for each of these states' 529s. So it's College Advantage for Ohio, and then My Florida Prepaid. Florida, this is where you would get started. You would create an account for yourself. You would name your child as beneficiary, choose the investments, and go from there. And I'm going to go ahead and open it up to any questions that we have. So there's a QR code here on the screen. If you want to schedule a meeting with me, you're welcome to. But I'm going to go ahead and look in the Q&A box here. If you have a question, feel free to type it in. I'll go through and answer some of these. So somebody asked, does this mean if we have a lot saved in a 529 plan, it actually works against our student for financial aid? So yeah, that was asked early on, and we covered that. Hopefully that answered your question, Diana. If my student pursues a master's degree, does the interest postpone further? I don't believe so, because that'd be for a master's degree, whereas you would have taken out those initial loans for undergrad. And you'd be looking at probably taking out additional loans for that master's degree. I have a friend who directs a community foundation that administers many scholarships. He says that it is a struggle to find applicants for many scholarships. He advises students to apply for as many as possible, even if it seems like they might not qualify. If no one else applies, it may be theirs. Yeah, thank you for sharing that. think about, different hobbies and interests that you have and, organizations around town that may line up with that. Typically, you know, you may write like a paper or, maybe even give some sort of presentation. But if you're chosen, there's plenty of scholarships out there for $5,000, $10,000 um, that you could have access to. Why would someone use 529 rather than using Roth IRA to fund college expenses? Um, Roth IRA, you have to have earned income is one of the pieces with that. So, if your child is not working, which if they're 5 years old, hopefully they're not, you wouldn't be able to put anything into a Roth IRA for your child. So you would just be contributing to a Roth IRA for yourself. Um, Also, probably best practice just to section out those accounts. Roth IRA is really meant for retirement, whereas 529 is specific for college. So can get a little convoluted if you have one account that you're planning to use for your own retirement and your kids' college. Maybe something to think about there. Great question so far. When you say 3, 6, or 9,000 per year to fully fund college, is that considering 18 years? Not sure I understand the question. Is that considering 18, like 18 years from now? Not sure I understand the question. On the danger of delaying savings page, what percent interest is that considering? It's a 6% interest rate. So maybe a little bit on the conservative end, but 6% return over those 18 years wouldn't be bad. Portability from daughter to granddaughter, for example, can this just be done through paid upon death or contingent beneficiary? Portability, can this just be done through paid upon death or contingent beneficiary? What account are you talking about, Susan? If it's the 529, then should just be as simple as going on to the account and changing the beneficiary from your daughter to your granddaughter, and then it could be used for the granddaughter. You wouldn't have a contingent beneficiary listed on the 529. You could have a for like the TOD account that I referenced, you could have a primary and a contingent or like a secondary beneficiary listed, but yeah, you would just have the primary beneficiary who the money is intended for on a 529. But you can certainly change that beneficiary from your child to your grandchild. That's um, great strategy if you've got money left over and you want to help out the grandkids too. Okay, so rephrasing one of the questions here, when you say 3, 6, or 9,000 per year to fully fund college, are you saying that's how much you would need to invest per year from age 0 to 18? If not, what span of years are you saying you would need to invest? Yes, you're correct. Yeah, that's from age 0 to 18, what you would be saving on an annual basis to, to be able to cover most of the cost when it comes to in-state public, mid-range private, and elite private. So, kind of ballpark numbers, but wanted to give you an idea of what you may be looking at there. And, if you really do have a goal of fully funding your kids' college, a lot of people have kids when they're like 30 years old. You're probably not making the same money at 30 that you will be at 40 or 50. You might not be able to fund as much in the early years, but then maybe on the back end, you're able to ramp up those monthly savings quite a bit. Great questions, everybody. Anyone else have a question? Go ahead and type it in the chat. if you need to jump off, thanks so much for your time today. Hope this was helpful. And I'm going to go back to a couple things here. So next month, we are covering Medicare. So we'll have a Medicare expert on to talk through this. Couple hundred different options when it comes to, supplemental plans through Medicare. So, really complicated subject. You want to make sure you understand it. Most people are going to use Medicare once they turn 65. So jump on this if you're interested. Here's our calendar for the rest of the year. So we do Social Security in October. That's a very important topic as well. I got another question here. Would you consider different funds for a 529 than you would for a Roth IRA? I would say it just depends on your time horizon. So we're big proponents of investing your money based on how long it will be until you use that money. Because the longer the time horizon you have, the more aggressive you can be. You have time to recover from a recession or a drop in the market. So if you are starting a 529 for your newborn child, I would say you could be aggressive with that money because it's going to be 18 years until you use it. But when you get to about 10 years from using an investment, that's when you want to start to reduce your risk. So probably around age 8 or 10 for your child is when you want to start to reduce the risk. Whereas a Roth IRA, if you're using that for retirement, then you'd probably want to stay aggressive until you're about 10 years from retirement. Another one here, I have 2 kids currently in college, one with 2 years left and one with 4 years left. We have been contributing to 529s for both, but have not saved enough to cover their hefty tuitions. Should we continue to direct our contributions toward their tuitions into the 529s? Or are the benefits of 529s really for time horizons greater than 2 to 4 years? I don't see any problem with still directing those funds toward the 529. I mean, if you're in a state that gives you the tax deduction, then that's one benefit is you'll save a little money on your state tax return if you're flowing the contributions through the 529 versus just paying it directly to the institution. Might not be a lot, but you could save some money there. And if you've already got the account set up and that's what you've been doing for the last several years, then maybe easy for you just to continue that same track. And if, even if it's sitting in there for a year or two until you use it, you may have some tax-free growth inside there. So yeah, I mean, ideally you've got, and it sounds like you've saved it in 529 for a while and done well, but the investment piece of it is important too. So ideally you're saving for 10 or 15 plus years and allowing those investments to work for you and grow. I have a junior in high school and have had a 529 for her since she was 5. But obviously this is getting real now. So this has been very helpful. Thank you. Yeah. Thanks for the feedback. Good job setting up a 529 early and funding that. Okay. I think we covered everything. So thanks again for your time. Appreciate you jumping on the call. Have a great Thursday. And we are here if you need us. Bye.